So the income received by unit trust will be exempted from tax. Okay, that is security or bond issued by or guaranteed by the government, debenture or other than convertible loan, stock approved by SC, bonds minimum simpanan Malaysia issued by one. It's actually we have a long list of these exemption of interest for the unit trust. Okay, these are the slide only give you a few, only 4 of it. You can refer to other material to get a full list of the exemption of unit trust. Exemption of the interest income for the unit trust. Okay. Similar to the ISC non-listed, okay, unit trust also has permitted expenses where we call it special deduction. This special deduction, okay, because you cannot trace these expenses under section 33, okay, similar with non-listed ISC. If you can trace the expenses towards any of the gross income, okay, so you can directly deduct the expenses under those income, under the income, kan? But in here, you cannot trace directly, mean that it is not wholly and exclusively incurred in generating the income. Okay, so that is called special. They will give you special deduction, but not all expenses that is other than section 33 will be allowed. Okay, similar like permitted expenses in the ISC. In here, the expenses which is not wholly and exclusively incurred in generating income, the income if the investment income, which is not allowable under section 33, but is allowable as permitted expenses. That is, we have 4 here, okay, different from the permitted expenses in the ISC. That is management remuneration, maintenance of register of unit holder, share registration expenses, secretarial audit and so on. So only expenses listed under these 4 item under special deduction will be allowed as the deduction under, it is referred as the permitted expenses. Kan? The same concept applied here lah. The one that you did in the investment holding company for the non-listed tu, similar. Kan? Because it involve a lot of expenses, but the expenses cannot trace directly to the gross income. Any of the gross income tu, because it is as a whole, kan, to produce the income, not only, cannot trace to the one specifically one gross income. It is overall, kan. So even though you have many expenses, but only these 4 under special deduction. Okay. So this special deduction different from ISC. Okay, last time for ISC you have different expenses, different list of A that is permitted expenses, but in here you only have 4, and then only a fraction of the permitted expenses is allowable to deduct. Kan? Where the formula is A multiplied by B divided by 4C or 5% of B. Kan? That is ISC non-listed. But in here under unit trust, you compare with 10% of A, okay, 10% of the permitted expenses, but now whichever is higher. Last time is whichever is lower, kan, under ISC. Now in here, they give you under section 63B special deduction a fraction of the permitted expenses. The formula is to compare with 10% of A, whichever is higher. Okay, and then the A, B, and C quite similar what you have in the non-listed ISC. That is A is permitted expenses, Okay, B is the chargeable income. Okay, the gross income which is chargeable, and C is the aggregate income, including the exempt income, and also gain from realization of investment. So that is C. The formula, the item for A, B, and C is similar lah with the one you have in the investment holding company. Alright. Okay. You know that for the unit trust, rental income itself is under Section 4D, rental income. Remember, when the income is under Section 4D, suppose has no deduction for capital allowance. Okay, but in here in unit trust, because of they give this unit trust specialized industry an incentive. Okay, so to ease the burden, because they involve with a lot of the qualifying capital expenditure, but they cannot claim for capital allowance. But even though that is the situation, they still give the deduction. They call it special deduction for QCE, qualifying capital expenditure. Okay, that is under section 63 capital A. This is allowable to deduct under adjusted income only from the rental source of the unit trust, and not aggregate income. This is under rental source because rental source involve a lot of QCE. Okay, the property lah kan, QCE tu come from the investment in the rental source, investment in rental to get rental income tu, it involve the QCE lah kan. So in here, it is not a normal capital allowance. Kan you learn about qualifying capital expenditure in principle of taxation. You apply the same here to compute the amount of QCE. Exactly the same. How to compute the amount of qualifying capital expenditure. Kan? But when it's time to determine the deduction, that is not apply the same method for you to compute capital allowance. That the special deduction here is straight away 10% of the QC. Right? So the capital allowance on QCE here, that is 10% of the QCE here, is deductible under rental income. It is deductible under rental income because this rental income is section for the investment and business. Supposed not to get capital allowance, but they give you, they call it special deduction under section 63 capital A. But you deduct under rental income for you to get, you deduct under adjusted income for rental income, okay, minus capital allowance, same here, then you get statutory income. Alright. Okay, it's not a normal CA given, like I mentioned to you just now, and then it is only 10% of the QCE. Okay, the rest is the same, like you will learn in your principle, that is must be the owner, use the asset and so on lah. Kan?
Doktor, suara doktor slow sangat.
Ya ke?
Slow
sangat, saya seteran.
Okay, yang ni okay.
Oh, saya kena tunduk.
Satu doktor tak record kelas.
Masya Allah. Awak cek tak abang tadi?
Saya dah check dalam chatbot, doktor tak perasan.
Tengoklah, kenalah abang. Saya buka ni sekejap. Sekejap. Aduh, kena unmute. Oh, call suara makin pelan. Saya buka, saya kat office ni. Aircon pun tak ada. Lunch hour ni ada betul-betul aircon. So, sekarang boleh dengar elok tak? Takkan saya nak ulang.
Okey dah Doktor.
Okay, saya record je lah From here ya. I record from here. Siapa tu, Nurul ke tadi tu?
Yes Doktor.
Ada Nurul lambatnya bagi tahu. Doktor tak record kelas ke? Aduh, pukul apa buat kita? 13. Aduh. Saya tak baca checkbox. Saya fokus dekat slide. Okay, I record and I continue from here. Boleh Okay. Alright, lupa. Okay. So, back to our qualifying capital expenditure just now. I mentioned to you earlier that the way to compute qualifying capital expenditure is similar that the one that you learned in the principle of taxation lah. So this is the one that you previously learned. QCE that is incurred in the provision of plant and or machinery, but in here only in deriving rent from letting of real property, because we deduct this QCE, the 10% of QCE under rental income, and the rest is the same lah with the what you learn in the principal taxation about QCE. Okay, so this is example taken from your module, okay, for the unit trust, okay, page 164, 165. Nurul dengar tak? Clear tak?
Dia macam slow lepas tu kuat. Yang ni okey dah Doktor.
Ya. Oh pula. Aduh. Okay. Okay, look at the example. Wire semua okey. Ada wire terlipat ke? Okay. Mana example? Okay, we look at the example. So, Bijan Property Trust, not a REIT or PTF. So, later you will learn about REIT and or PTF ni. Established in 2005, invest primarily in real estate, being investing in share and bond. So a building was acquired in 2019 and was rent out from 1st of June 2019. So before the building was rent out, additional elevator was installed. The capital expenditure on the elevator amount to 900,000. Okay. 900,000. This is the elevator. This is the elevator, 900,000, and the iteration cost that is 600,000. So from your lesson about QCE last time, so this is the amount that is qualified to be counted under the qualifying capital expenditure. The cost of the elevator itself, and then the iteration cost also be part of the QCE. Unless it's stated that to prepare the site, then you need to test 10% of the total cost lah. Kan? Yang tu yang you learn previously. Okay. And then they give you information about income. You have income that is dividend. You have dividend. You have this is Malaysia dividend. You have overseas dividend. You have interest, rent, gain from the disposal of investment. Okay, and then you have the list of the expenses. Okay, from the data given here, okay, you know that Malaysian dividend, okay, this is under single tier, so this is exempted from tax. Okay, and then dividend from overseas company, this is for range income, also exempted from tax. Interest because it already spelled out here that this is tax exempt, so also exempted from tax. Rental income definitely taxable, and gain from disposal of this investment definitely is not taxable. Okay, and then you need to determine which of the expenses that is allowable and which of the expenses can be traced directly towards the rental income. In here, only one income that is taxable, that is rental income. Okay, so you need to determine which of the expenses here is allowable to deduct directly under section 33, fully and exclusively in generating the income. What income? Rental income. Okay, you know here trustee fee is non-allowable expenses, management fees is allowable, property management fees is allowable expenses. This is under section 33 related to property. This is the expenses related to generate the income that is rental income. So you minus straight away under rental income. These expenses is expenses under, when it is expenses under section 33, it is allowable and deductible straight away under the gross income. Okay. Share registration expenses, allowable expenses. Okay. Audit, accounting and secretary allowable. Office rent allowable. Telephone and stationery expenses allowable. There is special deduction, yeah. Printing, yes. Assessment and quick rent, definitely this is rent. This is definitely under section 33. You can minus directly under the rental income. Okay. And then you have fire insurance. Fire insurance definitely towards the property lah, to for you to gain the rental income. So this is also section 33. Okay, where you minus straight away under rental income. Okay. So then you get this is adjusted rental income. Okay, after you minus the section 33, and then for you to get SI for rental income, you have a special deduction for QCE, but only 10%. Okay. In here, you know that the elevator is 900,000 and then the cost of alteration is 600. Cost of alteration in here near the so this is 600. 600. And then the total QCE now is 1.5 million. QCE. Ni yang saya nak buat amendment nak upload the PowerPoint to you ni. This kind of amendment I need to do because I copy this from your book, so it become image. I cannot amend the figure here. But the QCE is 1.5 million. Okay, the QCE is 1.5 million. This is QCE. Allowable special deduction for QCE is only 10%, so 150,000. So this is the CSI for the rent. Okay, and then other income, it is not taxable, but to play safe, to secure your mark, just put down the dividend in Malaysia and also interest which is exempted from tax. Then you get aggregate income. Okay, when you get aggregate income here, okay, one more deduction that you can deduct before you get total income, that is a special deduction. The one that we come across just now, that is permitted expenses. Okay, A multiplied by B divided by 4C and compared with 10% of A. Okay, the computation on your right, okay, this is A, the one you determined from the information from the income statement here. Okay, B is the chargeable income, C is the aggregate income. That is B plus exempted exempted income and also gain from realization of investment. Okay, after you deduct the portion that is take the higher this time. Take the higher, so you will get chargeable income. This chargeable income will be taxed at the corporate tax rate 24%. Okay, this is the amount of the tax liability. Okay, if you go to the public ruling that I mentioned to you just now, you can have other example lah for this unit trust. Alright, question? Farah, suara saya okey tak? Farah Nibras?
Ada doktor.
Okey tak suara saya?
Okey dah. Cuma sampai dia macam jauh sikit lah. Tapi sekarang dah.
Tinggal tak masuk dalam laptop yang lagi ni. Pujalah dekat saya duduk kat laptop ni. Tunduk lagi siap Farah. Tapi sekarang dah okey
Okey dah doktor.
Okay, we move to next specialized industry, that is real estate investment trust. REIT. Okay, this is one kind of unit trust. Still unit trust. It invests, which is invest in real estate and is approved by the Security Commission, is known as REIT. So REIT ni also unit trust, but what makes it different from unit trust is, okay, that is they invest in the where 50% of the total asset tu in the real estate. So that is REIT. And they invest 50% of that total asset tu invest in the real estate. What is real estate? Tanah kan? That is land, building, share, bond kan, and the real estate company. So SC, Security Commission, define real estate as land and so on lah kan, things that attach to the land. So this is the definition of real estate by the Security Commission. Okay, so if the company is not qualified as REIT, so it will be taxed again based on the unit trust just now, where we have permitted expenses, where section 33 we minus first directly from the rental income, and also we have section 63A, that is 10% of the qualifying capital expenditure. But if it is 50% of the total asset to in the real estate, so mean that this is REIT, so we treat the taxation differently as compared to the normal unit trust. Okay, if you look at here, the income is still the same. We have rental income, the main rental income here, dividend, interest, and capital gain. Okay, but the main income for REIT here is rental income. Okay, and also this REIT is also referred as sometimes we call it property trust fund, PTF. Property trust fund. Okay, dissimilar lah. Property trust fund tu is a REIT juga lah kan. Okay, so the tax treatment of REIT, okay, we have if I'm not mistaken 8 item about the tax treatment of REIT. Okay, the first one, okay, income from letting of real estate shall be charged to tax as a business source of income. Remember the ISC last time, for the listed ISC, we consider income from the listed ISC is a business source of income kan. So same here. Same here. Unit trust, the income is investment income. That is section 4D. But for REIT, the income is charged to tax as a business income. When business income, it has allowable expenses, it has capital allowance, it's different. It has more benefit as compared to the investment income. Okay, so any expenses incurred are deductible to determine the adjusted income. Still remember your company taxation? Okay, business income, all the expenses that is revenue expenses, okay, is allowable to deduct under the gross income. In here is under the business income for the REIT lah. Okay, adjusted loss. Adjusted loss suffered by REIT cannot be used to set off against other income of the REIT. For example, your allowable expenses, the expenses tu greater than allowable expenses for rental income is greater than gross rental income itself. Okay, so you will suffer adjusted loss. This adjusted loss cannot be set off against other income. Other income is, for example, interest income. Okay, even though you have interest income, but you cannot absorb adjusted loss, the extra expenses in rental income in interest income cannot. It is any unutilized cannot be set off to other income and also cannot be carried forward to the following year. Okay, all right. So this one is a special treatment of the REIT, number 3. Okay, that is income distributed to unit holder shall be exempted from tax at listed rate level provided that at least 19% of the total income is distributed. So if this REIT decide to distribute income, that is they distribute at least 90% of the total income to the unit holder, so the total income itself will be exempted from tax. Okay. If where less than 90% of total income is distributed, so no exemption lah. It's no exemption to be given to the REIT. So they will be taxed at the 24%, that is the corporate tax rate. Okay, so if they distribute 19% of the total income to the unit holder, the whole amount of total income will be exempted from tax. If they distribute less than 90% of the total income, the total income will be taxed at 24%. Okay, clear? Okay, number 5. Capital allowance shall be given to reduce the adjusted income of the REIT. Yes, because this is now considered as business income. Okay, so any amount unutilized not be allowed to be carried forward. So it's not same with the normal business lah. Kan, when we have an absorbed capital allowance, it can be carried forward. But in here, it's not allowed to be carried forward. Okay, so capital allowance, again, still about capital allowance. Okay, capital allowance is not restricted to the QCE provided to derive rental income. It also includes any QCE that are used in the business of REIT. Remember just now in the unit trust, okay, you have QCE, but the QCE is only QCE related to the rental income. Kan? and then the percentage is only the special deduction is only 10% of QCE. But because of REIT is considered as business income, income from REIT is business income, so they enjoy capital allowance, the normal capital allowance. And then the QCE is not restricted to the to the expenditure incurred to derive the rental income only. It is QCE which is include all the expenditure incurred for the business of REIT itself. It's a lot lah as compared to the unit trust. It is only specific to the property in the to get to rental income, but not in the REIT. Okay. So permitted or restricted expenses under section 63B of the Income Tax Act for unit trust do not apply for to REIT. Yes lah. We don't have permitted expenses in here. Permitted expenses to restriction of the 10% of A tu is only but we have the whichever is higher just now kan. It's only in the unit trust. In here no restriction because we have allowable expenses that is revenue expenses. And also administration expenses such as audit fees, management remuneration has no restriction that is that are fully tax allowable. Okay. However, trustee fees is not allowable under section 33(1). Trustee fees is always non-allowable expenses. Even though later you will learn trust body, another chapter, okay. Also, when it involves trustee fees, okay, it is non-allowable expenses. Same goes here under REIT, the trustee fees under unit trust as well. It is non-allowable expenses. Okay. So legal fees, valuation fees, consultation fees in connection with the establishing REIT prior to approval of SC shall be given tax deduction. In the year where a REIT commenced business. Remember last time when you learned about expenses incurred prior to the production. In here prior to the approval of SC. Previously you learned that is commencement of expenses, that is capital expenditure, and it is non-allowable expenses, kan? But in here, these expenses, legal fees, valuation fees, consultation fees, and that is in connection to establishing REIT, that is prior to approval lagi, kan? Even though that is the situation, it is given tax deduction. It is allowable expenses to be deducted, okay, in the year where REIT commenced business. Now remember that if you have this kind of expenses, it is allowable to deduct in the very same year when it commenced business. Okay, look at the example here for REIT. Okay, you have the question on your left, and then you have answer suggested solution on your right. Okay, look at the question first to understand the situation here. Okay, intellect land REIT. REIT mentioned straight away lah, this is a REIT. A listed and approved REIT receive rental from the letting of a hotel and take as an interest. Interest is very considered incentive. For the year ended 31st December 2019, REIT, Intellect REIT claim capital allowance of 15,000. So they have, the amount of capital allowance here is 15,000. Okay, and they give you information about income and expenditure. Okay, you have two income here. That is rental income from the hotel building. Okay, and also interest from the government bond. Just now we just learned from the unit trust just now. If this unit trust receive interest from the government bond, will be exempted from tax. So this is not taxable. Okay, and then you have information about expenses, a list of expenses where you need to determine whether it is allowable expenses or not. Okay, all right. So specific provision, it is allowable. General provision, it is not allowable. Okay, and then property management fees, allowable. Maintenance, yes. Insurance assessment and quick rent, yes. Trustee fees, we just come across just now. Trustee fee is always non-allowable. Okay. Manager's fees, allowable. Administration expenses, yes, allowable. Depreciation, always non-allowable. And loan interest. The word loan interest is allowable, but you need to read further the asterisk here. Loan interest is 100,000 related to purchase of government bond. So this interest, the total amount of 100,000 is related to gain income from the government bond. That is interest. This income is exempted from tax. When you incur costs to generate this income, when you incur costs to generate this income, the cost is now supposed to deduct under interest income. But because of the interest income is not taxable, tax exempted, okay, the interest expenses ni, the interest expenses ni will be disregard. It's like you minus under the government interest for the government bond. But now, because it is not taxable, no point lah. It will be disregard. Okay. So, your computation later on, you will adjust your value of net income. Okay, the value of your net income here. Okay, but this is not taxable. The interest from government is not taxable, but you add in the computation here to get income, net income here. So you will deduct the amount. You will deduct the amount. Okay, exclude the amount from the computation. And then you add back what is non-allowable expenses that we determined just now. That is general provision of bad debt, loan from the government bond, depreciation, and also trustee fees. Okay, so this is your adjusted income. For the REIT, you know this is considered as business source. You have another deduction that is capital allowance. You get the information from the first paragraph. The capital allowance is 15,000. You minus 15,000 to get statutory income or total income. Okay, and then you have information here where REIT made the following distribution in the basis period for the year of assessment. So in the current year, REIT distribute 1.57 million. Okay, that is from the current year income, where 275,000 from the interest from government bond, which is tax exempt. Okay, so you want to know the percentage, the distribution of the income to the unit holder that is exclude 275. That is only the one which is taxable, 1570. Okay, 1570, you divide by total income, okay, and then you get 90.22%. This is greater than 90%. So the total amount of total income now will be exempted from tax because the company distribute more than 19% of the total income to the unit holder. So no chargeable income and no tax liability lah. Okay, because they distribute more than 90%. Okay, this example two is only to show to you how to compute the percentage. Okay, so they give you information here. The rate received income and distribution for 2 years in 2018 and also in 2019. Okay, so you have rental income and also interest income. So this is your total income for 2018 and 2019. Okay, and then in 2018, from 12,000 total income, this rate distribute the amount to the unit holder, that is 10,000. So 10,000 divided by 12,000, the rate is 83%. Okay, when 83%, this is less than 90%. When less than 90%, the total income will be taxed at the corporate tax rate. So the 12,000 just now is not exempted from tax because the distribution is lower than 90%. So it will be taxed at 24%. Okay, that is 2.88 2,880. Okay, whereas in 2019, they distribute all amount of total income to the unit holder. So make it the percentage now is 100%. When 100%, the total amount of 14,000 here will be exempted from tax. The amount of chargeable income is nil, and also no tax liability for this year, that is 2019. Okay, before we proceed to FFM, any question? Nurul Ashikin, boleh dengar elok tak? Nurul Ashikin?
Doktor?
Boleh dengar tak?
Boleh doktor, elok.
Elok dah? Okay. Saya kena on apa ni, walaupun bateri dah penuh, saya kena on juga. Macam tu pula kan. Agak-agak lah kan. Alright. Now we move to foreign fund management company. Boleh? Okay, from the word itself, foreign fund. So the purpose is to collect the foreign fund, the foreign investor lah, is related to the foreign fund from the foreign investor actually. Okay, this the FFM ni is a company incorporated in Malaysia. It must be incorporated in Malaysia lah to be tax whatever kan, and licensed under the Capital Market and Service Act 2007. Okay, to show that this is FFM, so the company is required to have more than 50% of its paid-up capital owned by the foreign equity. So for them to obtain the license under the Capital Market and Service Act 2007, so they must at least have 50% of the paid-up capital owned by the foreign equity. So if they manage to do this, and then they are called FFM. So the setting up of FFM company in Malaysia will generate economic activities and allow Malaysians to gain the experience of their specialist fund management expertise and connection in the international fund market. So this is benefit to us lah in Malaysia, where we give they want to justify lah why they give this FFM special treatment of tax. Okay, why? Because we want to get their experience, we want to get their expertise, how to manage the fund, and we want to have the connection with the international fund market. Okay, so FFM company derive management fees income by providing fund management services to investor. So the income for the FFM is actually come from the service. We call it management service to investor. So the income is called management fees income. Okay. So we advise that our investor, local and foreign, then we will get the fees from them. That is management fees lah, kan? So management fee, this is our income lah, the FFM income. So FFM companies are encouraged to offer their fund management service to foreign investors in their home countries. Kan? This is FFM foreign. This FFM is actually from foreign country but incorporated in Malaysia. So we encourage them to have to give management service from the foreign investor where they come from their home countries. So we give special tax incentive that is under section 60G of the Capital Market and Service Act. Okay. So this is the tax treatment for the FFM. You have this in the public ruling, the recent one, Public Ruling 7 2019. This is also included in your supplement. Remember that early in the semester I provide to you the supplement from the author. The author for your book kan, they give to you the supplement to update the changes for year assessment 2021. So in that supplement also include this FFM, but the public ruling is actually back in 2019 lah kan. But you can also read the public ruling and the supplement given to you to know more about the FFM. Okay. FFM company derive income from management fee charges for its service to foreign and local investor. We come across this one just now. So the income is treated as business income under section 4A. Similar like our read just now, the income received too is not considered as investment, but it is considered as section 4A business income. Okay, income from local investor and foreign investor will be treated as separate business income. Separate business income means that you need to compute both income from local and foreign investor separately, individually. Okay, you cannot combine the two investor in one computation. Kan, similar lah with business income. That is the concept behind the business income. Kan, you need to do it separately. Okay. So the tax incentive or special tax treatment for FFM is only applicable to income derived from fund management services provided to the foreign investor under conventional fund management system. So we will look at this while we go through your example afterward. Okay. Alright, this is taken from your from the public ruling 7 2019, the tax treatment. Okay. So the computation of chargeable income for income received from fund management service divided into two lah. You compute separately. Remember just now, compute separately between foreign investor and also local investor, because this is business income, section 4A. Okay, you have allowable expenses and also you have capital allowance. Similar what you have in the similar concept you have in the company taxation, where gross income, this is management fees, is a gross income. Okay, considered as business income minus allowable expenses to get adjusted income and minus capital allowance to get statutory income. And you do for both for foreign and also local investor. And then after you get statutory income, okay, you are allowed to carry forward your business loss from previous year to deduct in the current year. Okay, you minus loss brought forward for you to get chargeable income. Same goes to the to the local investor. Okay, to the local investor. Is allowed to carry the loss brought forward, but the loss brought forward in here is only is not from the foreign investor. It's not from the foreign investor. Same goes in the computation of the chargeable income for foreign investor itself. Okay, the loss brought forward in here is from the the computation of loss from the foreign investor itself. Okay, this is example taken from your supplement. Okay, we try to understand this example. This is a good example for you actually. Very recent example in the public ruling, if I'm mistaken, this one. Okay, Prince International Fund Management was established as FFM in 2010 and received SC approval to provide fund management service for both local and foreign investors. They give to you the information about income and expenses for 2 years, that is a year ended 31st December 2020, and also year ended 31st December 2021. So you have 2 years to do the to compute the tax, to compute tax. In year assessment 2020, you have the income, expenses, and also the capital allowance. Same goes to the 2021 for both foreign investor and local investor. Okay, and then the question asks you to compute the chargeable income for the FFM lah. Okay, for both year assessment 2020 and also year assessment 2021. Okay, look at the solution here. For year assessment 2020, okay, for foreign investor, you have management fees of 200,000, and then your allowable expenses is 210. In here, you get adjusted loss, not adjusted income, but adjusted loss because your expenses greater than your gross income. So this 10,000 will be loss brought forward, where you can deduct in the following year. Okay, and then you have capital allowance for 20,000 in year assessment 2020. Kan? Because of your adjusted loss, you cannot absorb your capital allowance. So your capital allowance also can be carried forward for the following year, only to carry forward under foreign investor, not for the local investor. Okay, look at the following year for the foreign investor. Okay, you have management fees minus allowable expenses. Then you get adjusted income now. Alright, so you minus the capital allowance, that is the current capital allowance, and also the capital allowance brought forward. Then you get statutory income. Remember the loss just now, loss brought forward, is deductible under statutory income. Okay, you deduct loss brought forward from the SI, then you get total or chargeable income. And the tax rate is 24%. But remember, for foreign investor, the special rate for foreign investor happened in year assessment 2020. That is the tax rate for foreign investor is only 10%. If, for example, you have figure here, you have adjusted loss, you have amount here, minus capital allowance, and also you have amount for SI, okay, and later you have amount for total income. The tax rate now is 10%. Kan? 10% for year assessment 2020. This is special provision for foreign investor. Ingat yang ni. Okay. But in year assessment 2021, it go back to 24%. Okay. For local, you compute as usual, quite similar what we have in foreign investor, only the tax rate is still 24% lah. It's not given any special provision for the local investor. In year 2020, the tax rate is 24%. Okay, same goes here. You have management fees minus with your allowable expenses, adjusted income, minus capital allowance, you get SI, and it's also your total income multiplied by tax rate, you get the tax ID lah. And do the same for your assessment 2021. Only for your 2021, it has you have no adjusted income. You got adjusted loss here for 20,000, and you cannot absorb the capital allowance here because no adjusted income. So the two amount here, that is loss for 20,000 will be carried forward in the following year, that is year assessment 2022. Same goes to the capital allowance, where you cannot absorb in the year assessment 2021, this one will be carried forward to the year assessment 2022. Okay, senang kan? Okay, ini just now tadi lah. You can bring forward though. Okay, you have some more actually. You have some more. Investment incentive, closed end fund, venture capital company. Okay, please read your module or your book in public ruling. So we end our chapter lah for chapter 7. So any question? Soalan. Praveen, question? Solihah, question? Atin, question? Okay, Daruni kata okay. Any question before we end our session for today? Tana kata no. Oh, so means that everybody understand lah kan? So I will stop recording now. So you, the rest of you may scan the attendance. Kamaru pun okay, good. Sekejap ni apa ni? Wah, if the interest from government bond is taxable, kenapa taxable pula? It's not taxable lah. Interest from government bond is not taxable. It's not taxable. Okay. Okay. You are ready to do your tutorial now? Okay. Similar like morning class, the submission is this coming Sunday. So I will call you based on group lah kan. Perhaps I will call Puah ke kan to answer question number 1, and then Atin to answer question number 2, Syafiq to answer question number 3. So Puah group nanti will help him to explain further lah kan. I will ask you during the presentation later on. Ready, please be ready lah. I don't know who I will call later on this coming Sunday. You submit tu you dah ready lah with your answer kan. So you submit your answer on Sunday morning before 9, and then during class we will discuss lah the answer to fully understand lagi lah this topic. Boleh? Boleh Puah? Puah boleh? Kan kita nak determine siap-siap siapa yang nak present. Puah okay? Puah kata okay. Good Puah. Alright, so ada lagi ke yang tak sign? Nurul Izzah ada? Nurul Ashikin, Nurul Izzah ada?
Ada doktor.
Ada, tak scan?
Ada doktor.
Ada. Pakai phone ke? Set Alright.
Doktor.
Okay. So with that, we end our class for today. Okay, see you again this coming Sunday with your tutorial answer. Okay, Assalamualaikum and have a nice day.
Thank you, Doktor.
Betul.
Don't be shy. Yeah, you're all right. We've been safe.
My pa always told me, rest.
He did just about perfect.
大家好啊！今天我就要开始聊 Red Dead Redemption 2了，也就是我们俗称的打猎模拟器，别名《荒野大镖客：救赎2》。说起来时间也过得很快，大镖客已经发行2年多了，我们也可以抛开热度和话题性，来单纯的品味这部好作品了。